Today, a deep dive on household debt and income ratios. Hi again, it's Martin North from Digital Finance Analytics, well, that is post covering finance and properties with a distinctively Australian flavour. Well, the RBA has updated its statistics, including its selected household ratios. And I thought I should go through these ahead of my upcoming live stream tonight, where I'm going to talk about household stress, insofar that some of the data the RBA presents is, well, superficially okay, but when you drill down on it, then you have more questions. But before we look at the RBA series, let me just remind you that the annual credit growth aggregate for housing, according to the RBA, rose by 7.8% over the last 12 months. And amongst that, owner occupation rose 9.89%. That's the strongest growth in years. And investment lending was also strong, up 3.9% over the last 12 months. So we all know that the amount of debt in the system is rising, and that of course has significant impact on households and their ability to service the debts that they're dealing with. Also, it's worth remembering that wage expectations ahead are pretty muted. This from some earlier research that was published, and then the budget also showed that the wage price index is expected potentially to rise over inflation in 2023 and 2024, maybe. That's their best estimate, of course. But on the other hand, we know that historically they've had a pretty bad track record of actually being able to estimate accurately wages growth. And there is a question, of course, as to what happens to wages growth, specifically if migration increases, as everybody wants. Well, not everybody, but quite a few people actually. And I have a feeling that wages growth will not be as strong as they're expecting. Now, there's one other factor to bear in mind. We also know that the average loan size for new loans continues to accelerate. So we know that there is more debt in the system at the aggregate level. We know that there is more debt in the system at the individual loan level. And we also know that incomes are quite compressed. So then the interesting question is, how does this translate to what is going on in the ratios that the RBA presents? And you can ask yourself the question, what are they trying to tell you through these various aggregates? So let's look firstly at assets to income. So this is what the RBA says in their notes. The data on household assets and liabilities are not seasonally adjusted. Data on household income and interest payments are seasonally adjusted. Household assets refer to the total of residential land and dwellings, consumer durables, and financial assets. Housing assets refers to the total of residential land and dwellings. Assets, debt, and net worth are reported as stocks at the end of the quarter. And for the purpose of calculating the debt to disposable income ratios, except for owner-occupied debt to disposable income ratios and assets to disposable income ratios, disposable income includes gross mixed income earned by unincorporated enterprises and is measured before the deduction of interest payments. Data on disposable income are seasonally adjusted and is reported in annual terms. For the purpose of calculating the owner-occupied debt to disposable income ratio, disposable income excludes gross mixed income earned by unincorporated enterprises and is measured before the deduction of interest payments. Data on disposable income is seasonally adjusted and is reported in annual terms. The first line here is the ratio of household assets to income. And this shows you that the value of assets held by households at the aggregate level is increasing relative to income, because we know that income is not growing very fast. The same is true of housing assets to income. And household financial assets to income are also rising, but by no means as quickly. And of course, it's worth reflecting here on the fact that we know that property prices have been rising in most areas quite strongly, houses more than apartments. And we know that assets held in the financial system, stocks and shares, etc., have also grown in value thanks to the quantitative easing programs, although of course in recent times, particularly this year, their growth has been checked. And bearing in mind that this data, of course, from the RBA only goes up to the December 2021 quarter, so none of the recent falls in financial assets are reflected in these numbers. Now, the next ratios that we're going to look at are the debt to asset ratios. Household debt includes debt owed by unincorporated enterprises. Housing debt includes debt owned by unincorporated enterprises. Owner-occupied housing debt is calculated by the RBA and excludes debt owed by unincorporated enterprises. And the first one is the household debt to total assets. So total household debt to total assets, and that ratio has dropped. Again, not surprising, because the value of property and the value of financial assets have significantly accelerated relative to the debt in the system. Although the debt has been growing, the assets have been growing faster. It's also true for housing debt to housing assets, because once again, the value of property has accelerated dramatically, particularly over the last year or two, thanks to very low interest rates and quantitative easing. And of course, it's not equally spread across all households. Some households have very little debt or no debt. In fact, only 1/3 of households are borrowing. So this, of course, has an impact on the overall ratio. Now, the next one we can look at are interest payments to income. And for the purpose of calculating the interest payments to disposable income ratios, disposable income excludes gross mixed income earned by unincorporated enterprises and is measured before the deduction of interest payments on dwellings and consumer debt. And data on disposable income is seasonally adjusted. From the September quarter of 2019, interest payments are calculated using a weighted average of interest rates on outstanding household debts from the Economic and Financial Statistics collection. And it's worth just underscoring that here we are talking about interest payments to income, not total mortgage repayments to income. So this is servicing the debt, not necessarily repaying the debt. And not surprisingly, with the very low interest rates that we've now got, the ratio of interest payments to income is significantly lower than it was after 2008. And this reflects most strongly the fall in interest rates over recent years. And it's also true for those relating to servicing mortgage repayments, as shown in the blue line. But the final one to look at is the debt to income ratios. Data on household income and interest payments are seasonally adjusted. Household interest payments to disposable income is the ratio of interest payments on housing and other personal debt to quarterly household disposable income. Data excludes unincorporated enterprises, and from 1993, these data points are calculated by the RBA using average interest rates on outstanding housing and other personal debt. Housing interest payments to disposable income is the ratio of interest payments made on housing loans to quarterly household disposable income. Data excludes unincorporated enterprises. Now, this, of course, again, has a number of caveats attached to it, but what we do see is that the household debt to income ratio continues to rise. It's well over 180 now. The housing debt to income ratio also is rising, and the owner-occupier housing debt to income ratio is rising as well. Now, this, of course, is the function, as I've discussed, of flat incomes relative to bigger loans. And that's come about because the lending standards have been looser. People have been able to get bigger loans because essentially the banks think that they can service bigger loans because interest rates are lower. But of course, that begs the question, what's going to happen ahead? And as you know, and I know, we do expect incomes to remain crimped, but we expect interest rates to rise. So there is considerable sensitivity here to what may happen. And more broadly, I make the point that whether you look at the ratio of household debt to income or those other ratios, if interest rates do start to rise and the amount of repayments have to increase from households, those other ratios are going to look a little sicker. Plus, of course, the risk is that property prices now may be on the turn, and therefore the expectation of future asset values may also be depressed. So I'll leave you with this question. Do these ratios really tell us anything at all that's really important? Well, it does give you a trend over time, but as I've demonstrated, the mix of data presented here is rather fragmented. And of course, it's an average across all households. Not all households are borrowing and not all households have a mortgage. So to that extent, actually, these ratios are frankly pretty meaningless. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.